right. What's up, y'all? Welcome back. Issue 19, cut 2. Today we are going to be jamming on an operating concept, and it's a little bit of a departure. And typically the operating concepts are catered towards operating in this a SaaS firm of some type. In our context today, we're going to be talking about operating concepts from the investor side of the fence. And you know us, acquire and operate for the love of the game. I got my boy K. Lou, fresh off a birthday weekend, looking bright as a daisy. How you doing, my friend?
Oh, I'm feeling amazing. Happy to be here, man.
No doubt. Well, let's jump in. So cool. So I got a nice little visual for us to start. So let me pull this up.
Gotta love visuals.
Gotta love visuals. Good for storytelling, turns out. All right. So this is the landscape of private fund management or alternative assets, as it's more often referred to, right? So you have traditional is publics, stocks, bonds, stuff that's liquid, stuff that trades on an exchange. On the alternative side, you have private equity and venture capital. What's interesting is venture capital is private equity, right? You're taking equity positions in private businesses. There's also real estate. That's another very conventional alternative asset. Crypto is alternative asset, commodities, gold. Well, I guess those are their own category, but you can consider them alternatives. It's basically anything that isn't stocks and bonds is generally acknowledged as alternatives. So here we can kind of see, and there's some different ways to render this. To fit it all on one graph is a little trickier on one visual, but typically this is a function of revenue. So at the very beginning, you have venture capital, seed stage, Series A, Series B. And the play here is, hey, we've got a good idea and a team that you believe in. Cool. We're pre-product. Great. We're post-product, but we're pre-revenue. Okay. We're post-revenue and we've got some traction. Okay. Now you're starting to look at what would be considered kind of growth equity. And then as you continue up this, what should be a maturity curve up into the right rather, then you start to get into buyouts. And here it's framed as leveraged buyouts because more often than not, whoever the acquirer is, us in many cases, or in this context, you take debt to make the acquisition, just the same way that you get a mortgage for your house. So leveraged buyouts and buyouts are kind of synonymous. And then beyond that, you have distressed or turnaround situations. And here it's kind of like, all right, revenue's actually we're in the red because it's just burned. Okay, revenue's starting to come. Okay, cool. We're stable, great. That's a leveraged buyout. Cool. Oh shit, things are going to decline. Now we're
Back
talking
down.
distress and turnaround, right?
Yep.
And this assumes equity in this top bar here.
Mm-hmm.
Below that, we've got credit strategies. And again, this basically just changes as the risk profile changes. So direct lending, and that has all kinds of flavors. SBA is like kind of the usual suspect in small business loans. Then you get into mezzanine. This is a little more structured. There are some terms here. And I guess the assumption is that the risk goes up as you move towards the right. So in distressed turnaround environments, it's going to be a collateralized loan, or they get paid back first. They're at the top of the capital stack, which is almost always the case, but this lender would be at the tippity top. And so that's, again, kind of a function of risk and reward, just like anything is. And then you have industry specific stuff, which is mostly the acquisition of hard assets, like infrastructure being like a really heady one, which is like bridges and tollways and stuff like that, but more conventional is real estate. And then if this was Inception, we're going to go one dream deeper. You have fund of funds. So this is big pools of capital that take position in funds that are doing stuff in the top 3 charts. And this is, let's say you want to invest in Vista. Well, you need $2 million and there's a line around the neighborhood to invest in Vista. So it's very tricky, right? There's kind of barriers to entry for the more common conventional investors. So what do? They give their money to a fund of funds, they pool their money, and then they get positions in some of these awesome funds. And that way the LP can, or the investor, however you want to call it, gets exposure.
Makes sense.
So this is the lay of the land. Thanks to our friends at Mergers and Acquisitions, they put together a really nice article. So that source is there. If you want to dive deeper, it's hyperlinked into the gills, so you can dive really deep on any one of these areas. For us, we're using the little dippity dots here. And what's interesting too is I could have pulled it all the way out here. I think the takeaway is we're playing private equity, which means we take ownership positions in private, non-public companies. Some are growing a little bit. we're always buying out, which means we're taking majority ownership and we're stepping in and operating, or we have operating teams that step in and operate. For us, we are operating. And then there's a little bit of a distressed turnaround component too, because maybe you'll find a firm that has, a very subtle structural decline in revenues, but you're bullish on the product and it hasn't gotten it. And that's usually a function of, there hasn't been the amount of capital needed to keep the product relevant, or they haven't been able to execute on the roadmap at the same pace that the competitive set has, et cetera. So this could arguably go out here, but the bottom line is we're not playing venture capital, which is this company's growing 300% year over year, or the market is new and emerging, right? Generative AI is the one right now. So it's like, holy shit, this is going to be and then you'll see a lot of kind of top-down math there where it's like, all right, if this market's going to be $2 trillion and we can acquire 1% of it, we're going to be billionaires. And it's like, okay, but that's venture. And I guess another important distinction there is that power law is the name of the game. So you're trying to get exposure to as many firms that you are optimistic about. And the assumption is that 2 out of 10 are going to totally spank it out of the stratosphere and generate the returns you need. And then the other 8 are probably walking dead, or they'll just provide, kind of meh returns. So we're not playing that game. This is where horizontal SaaS firms play. This is where groups that are going after big categories like developer tools, et cetera, that have, the potential for billion-dollar outcomes. We're playing niche vertical SaaS. And in our context, it's always buyouts. Sometimes there's a little bit of growth and sometimes there's a little bit of decline. But that's the game we're playing. Cool?
Gucci gang.
All right. And I should have mentioned at the tippity top, and forgive me that I didn't, that like the operating concept that we're going to be leaning into is like the way that a PE firm or a buyout firm, just to keep it specific, can kind of articulate their thesis. So, like you have sales motions, which is a rip and replace, right? It's like, there's an old dusty incumbent. Our shit's newer and doper and better. We're going to go in and replace them and take their market share. There are point versus platform pitches. So there's kind of broad strokes ways to categorize stuff. And obviously with private equity funds, it's the exact same. And why does this matter? Well, our assumption is that you're going to be raising capital. And so investors, by way of metaphor, speak French. So you want to make sure that you come correct with French terminology to A, accelerate the communication, and B, get to a place where you raise your capital faster. So you want to be very clear on like, how would our fund be viewed in the eyes of a sophisticated investor? Cool. Let's make sure that we have that as a headline here so we can articulate what we're after. And I think as a function of that, it helps you understand and drives clarity around what you're actually doing. So it's important to know where you fit in the sandbox and to use the appropriate language so that you can accelerate conversations and communication.
Simply said, do your homework and be prepared to present.
Speak the speak, man, straight up. Okay, so now we're going to dive in, and there's a lot of applications here that I've kind of already touched on. So the very first one, and I'll just rattle these off first just to provide a little bit of a path of where we're going. So you've got top down. Oh, God. I'm just going to use the singular version. No thesis. You'll get one thesis for today. That was 2. So we've got top down thematic investment thesis, sector specific investment thesis, bottom up investment thesis, roll up or bolt on acquisition strategies, turnaround investment thesis, and then lastly is opportunistic investment thesis. So what you'll find, as with most things, is that there's a lot of gray. And so it's very often that you're going to be kind of combining the terms here, or you find a way to articulate what you're doing by leveraging some of these terms. So they're not mutually exclusive. It's not like if you are this thing, you can't be the other things. It's probably more likely that you're a little bit of a few things, and then you need to determine how you define it. And that's probably by determining where you land the most in which pot. All right, so top-down thematic investment. So this is basically where you are creating a view, a well-researched, thoughtful view on where the world is going. So one top-down investment thesis could be like mobile first. We believe that mobile is the most important platform, right? At the beginning, it was like internet. The internet is going to rip, right? And Bezos is like, holy shit, this thing's growing 1,000%. Like, I want to be the internet store for everything. Yeah. We know how that turned out, right? And then it was social, where it's like, hey, businesses don't just have websites, humans have websites. And if we network them digitally, a lot of stuff happens, and we can harvest a lot of data, and that's useful for ads. Then came mobile. et cetera. The example that I used is just because this one's kind of recent, and obviously there's some recency bias for you, is like when COVID happened. There were a lot of hedge funds that execute top-down thematic investment thesis, and a lot of private equity shops as well. So you could say, okay, COVID just happened. It just pulled forward all these digital transformation trends. People are going to be more inclined to work from home. What does that mean for real estate? People are going to be more inclined, or people aren't going to work. So like let's invert it. They're not going to work. They're not going to the gym. They're not going to movie theaters, and they're not dining out. Okay, what companies are going to outperform in that environment? So you'd be like, cool, we're going to start a Peloton bike thing, or we're going to buy Peloton. We're going to buy the company that makes standing desks. We're going to buy the company that makes, at-home webcams, and we're going to go long on Netflix, right? Like whatever the case may be. But the thing is that you have a top-down view that then informs your strategy, and then you go find and identify what you would believe will be outperformers in that environment. Make sense?
That makes total sense. It's similar to the AI, the generative AI movement right now. It's similar to like what happened with crypto back in the day, although crypto kind of flipped on its head for a lot of hedge funds. So no, makes total sense.
Totally. And this is where you'll see, and I guess this is kind of like probably the most conventional, but like if you'll see like a venture shop will put together like a really robust industry landscape, this is what they're doing. So they're like, we know that generative AI is going to rip, right? And it'll be like, okay, we have text-based GPT, we have image-based DALL-E. What are all the applications of text-based? Boom, we've got sales stuff, we've got creator stuff, we've got developer stuff, and they're trying to figure out what's on the map. So you guess it, identify blank spots and like, ooh, this is blue ocean, we should go hard at this. Or, ooh, there's a consolidation play here. It seems like there's a couple onesies, twosies here that are playing, let's go roll them up, et cetera. So top down. And in our world, and again, always trying to tie it back to Micro SaaS, in our world, basically, you just want to be confident that the category is stable, right? What you don't want is a category in structural decline where, I don't know, what's an example? What's something that ChatGPT is eating a lot? I mean, anything, right? It's just like, hey, we want to buy a dog walking SaaS. It turns out people are buying less dogs and the category is shrinking by 5% year over year. Not great. You can compete there and you can extract some returns, but you want to play where it's stable or you have a small tailwind that's kind of puttering you along. Okay, good to move on?
Good to move on.
All right, sector-specific investment thesis. And what you'll start to notice, right, is that I would say Micro SaaS, just to kind of cut to the chase, is very much a sector-specific kind of bottom-up approach, right? Where we are focusing on kind of broad stroke categories. And in our case, vertical SaaS is very broad, right? So you'd probably want to actually understand some niches within that you're jazzed about, weird categories like countertop fabricators or whatever. And then you're looking at the business opportunistically because it's for sale, right? So the seller has intent. So it's a bottom-up analysis where you're looking at the fundamentals of the business, the metrics, the revenue, the product market fit. You're feeling very confident about those things. Maybe there's some roll-up to your strategy. And then lastly, there might be a little bit of a turnaround component too, where it's like, hey, this revenues are in decline by XY% year over year, but it's in a vertical we like. We see some roll-up opportunities and the bottoms up financials look good. Like our analysis of the fundamentals looks good. So kind of just to cut to the chase there. So back to sector-specific investment. So this, and I would say vertical SaaS is like the section of the library, right? It's not even like a book. So like you can get way more specific. So like for us, it would, for sector specific, you could say vertical SaaS. Down below that, it could be like small business productivity tools. Down below that, small business productivity tools. So vertical SaaS, small business productivity tools, project management. So you can get think of it as like taxonomy, right? So like you can get way, way more pointed. It's like we only go after project management SaaS, period. That's our whole thesis. So you can get very definitive with the sector specific component. And in our use case, we just want it to be in a vertical that, again, is stable and that we like because there isn't some large incumbent that's dominant, something like that.
Agreed. I would say the flip inverse of that would be horizontal SaaS. Always good to give the audience an example, which would be something like Slack. It can be used across any kind of sector you can think of, and anyone can essentially just set it up in a few minutes and get the best out of it. Similar to Salesforce. They're in health tech, they're in fintech, they're just across the board, and they provide a bunch of different solutions. Wherein it's not just a point solution, but now you can do your email marketing, you can manage your pipelines, and it's all related to your process, regardless of the industry or sector you're in. So I think it's always good to show a difference in this is vertical versus what's horizontal, just to drive that comprehension.
Yeah, and another kind of good rule of thumb is horizontal SaaS is usually for a team because every business has a team. So it's like, ooh, this is for designers. Turns out 80% of the world has designers, or this is for HR departments. 98% of the world has HR departments. So that by definition falls into the horizontal category, which if you could sell an HR tool to every small business under the sun, you're going to have $1 million in revenue. And honestly, there are only markets like that where you even have a chance to grow to that level of revenue. So anyway, Gucci, on
to your point there as well, like when we talk about horizontal, that kind of falls right into the roll-up side, because if they're targeting teams, right, you may start to notice some small companies that are underperforming, kind of like what Salesforce has done over time, and then just start to acquire those companies to acquire that larger market share to really bolster their revenues.
Totally. Or it's like Salesforce was built for, well, really the executives at sales teams who wanted visibility into pipelines. And then it's like, well, you know, what impacts the success of the sales team? Their marketing team. Okay. What tools do they use? Okay,
Yep,
cool.
let's pull that in.
Let's roll it up. Here we go. It's not,
Yep.
rocket science. Okay. On to a bottom up investment thesis. So this is, I guess, this is most often, because in Micro SaaS, it's like, hey, we have a point of view that's top down. Let's now go out into the world and find companies that are firms that with sellers who have intent, right? These are listed firms, et cetera. Let's go establish a relevant universe of private companies that don't have intent. Now we're going to get some outbound going, and we're going to try to, persuade those groups to sell, et cetera. So with us, the benefit is that I would say the vast majority in our contacts, you execute bottom up investment analysis where it's like, hey, we're looking at this firm, we're looking at the fundamentals. What do revenues look like? What do unit economics look like? What do we think about talent? Everything that kind of fits into our scorecard. And then you make the call on that business. Obviously, you don't do that thinking in a vacuum. You're very thoughtful about the competitive landscape, about a whole garbage bag full of factors. But at the end of the day, you're looking at that specific firm. And then the top-down bit is a little bit of an afterthought just to check the box. Like, is the category in good shape? Gucci, let's move on. Cool. So roll up. Bolt-on strategy. So this one is interesting because there's a few flavors. Most often, it's like they treat it as a platform. So let me do it. Let me shoot for a metaphor here. Let's see how we do. It's like, hey, we're going to go buy this kitchen because we know that the kitchen is where most families hang out in the house. And oh, by the way, there's a very suitable master bedroom and a garage that we could buy and roll it up, and now we're going to have a huge house. How is that? Is that
That's
right?
not bad. I like the real estate analogies.
All right. And real estate works so well with that. So, and roll up the kitchen in that example would have been the platform. So it's like, hey, this is going to be a platform for us, and meaning that we're going to go make acquisitions, often called bolt-ons, tuck-ins, and we're going to roll those companies in, and we're going to keep feeding the beast. That thing is Voltron, and we're just going to go add arms and legs, right? And we're going to make it super badass. An alternative is where you're like, hey, we're going to go buy a kitchen. We're going to go buy, or we know there's a kitchen out there. We know there's a master bedroom, master bathroom, et cetera. And you basically go buy really small parts and smush it together into one entity that didn't necessarily exist before, but you're not necessarily treating the thing as the thing that you bolt everything else onto. So there's a few different flavors there. I would say the most conventional one is you have a platform and then you go acquire. And in that context, like if we go back to Salesforce, it'd be like, hey, we've already owned the sales team up and down the food chain. Now we're going to go get marketers. Okay, cool. And then that's kind of like acquisition via adjacency in terms of markets and customers. You can also think about it technology wise. So for Salesforce, it could be like, hey, we're missing the mass emails. So we're going to go acquire this firm that does a bunch of shit, but the only reason we're acquiring it is because of their technology for mass emails.
Yeah.
So you can think, and that's kind of backward and forward integration. And usually that's around like the work stream and the technology and the tooling that underpins it.
Yeah, that's right in line with HubSpot recently acquiring Clearbit to handle the enrichment. Right.
Beautiful example. Outstanding example. It's like, hey, we need to send emails, and to do that, we need email addresses and we need firmographics so we can send them to the right profiles. And it's like, and we have an integration. And also something that almost always informs that is integration partners, where it's like, okay, how's everyone doing that now? It's like, well, dude, you just plug in Clearbit. It's like, all right, well, let's buy Clearbit.
Yeah, and after a while, you can start to notice that strategic alliance growing over time. It's where all form submissions, if you have HubSpot, you have to go get Clearbit. It just makes the most sense because it gets you the best data. And after a while, you're like, I wonder what that relationship is going to go into.
Totally. Totally. So that one's pretty straightforward. I mean, all these are kind of straightforward. It's the gray that makes it a little interesting. All right,
Yeah.
turnaround. If something's going one way, you buy it and you take it the other way. It's a turnaround, right? Kind of
Yep.
self-described here. So in this situation, it's basically structural decline. So the most conventional one is revenues are in decline. The most conventional is that churn is unwieldy. Another one is maybe the capital structure is killing the business. So they don't have enough money to pay their debt service. So a lot of times there's like a restructuring of the capital stack in turnarounds just to buy more air. So it's basically like, hey, we'll come in, we're going to underwrite the debt and figure that stuff out and reduce our debt service so we have a little more runway, and we're going to bring a bunch more cash to the equation to fuel growth and improvements, et cetera. But this is taking a thing that's not doing well and making it rip. And turnarounds are for ballsy people. So this is like flipping a house that like is, has asbestos. You're like,
Yeah.
and it's like, if we get in there, we bought it at like 30 cents on the dollar. And if we don't get asbestos and die, we're going to sell it for $1.50 on the dollar. And it's like, oh boy, that's a big return.
Yeah, I was gonna say, saying it's for ballsy people is right on the nail, because while you put an emphasis on the financial side, there's a lot of work that has to go into turning these firms around. Sometimes it might not have been the right processes, it might not have been the right people, and now you have to go in and figure all of that out. And now you have to become that guru to literally say, here's exactly what needs to get done. So a lot of times it's a lot of sleepless nights and way more than the finances that go in and out.
Totally. And like, some of the greatest acquire operators of all times are turnaround people, or like turnaround CEOs. You can make a living as that.
Yeah.
But obviously it's very difficult. So, I mean, momentum in business is very difficult to turn. But the value creation is insane if you do it well. So that's that. And then lastly, opportunistic investment thesis. And just as we were chatting about before we hit record, Kev, I mean, I threw in a disclaimer here, but this is like, because I guess everybody wants to be opportunistic. It's kind of like,
Let's just say that.
It's kind of the thing. It's like, yeah, dude, you take advantage of opportunities. That's what it's all about. And in this context, traditionally, you'll have a fund that has a very explicit mandate. So, Kale, you're going to invest in micro SaaS, vertical B2B. Cool. Here's my money. Let's say we're out there and we're like, dude, it turns out that this dog care firm that's a brick and mortar store in my neighborhood is for sale, and it's an absolute steal. We can't act on that because our investors gave us money for exposure to micro SaaS, B2B, boom, boom, boom. And I think at best, they're like, oh yeah, I like dog walkers, but I already invested this fund or dog salons. I already invested this money in this group that's going after that. So I don't want to put more money in that pile. That pile is already allocated. At worst, it's like, I don't agree with you and I want zero exposure to that category. So what this typically means is that, more traditional institutional investors, financial sponsors have an opportunity fund that is the catch-all for good deals that they come across that don't fit neatly into the funds that have a very explicit mandate that their LPs are holding them accountable to. Make sense?
Well said.
Okay, cool. So that's what this means here, is that there are these opportunity funds that don't really have a thesis. They're like, we find deals that we like and we do them.
The way I'll use an analogy of what happened with GameStop and the retail traders. Most people will start at the opportunity because they're all on news. They're looking at Jim Cramer with Mad Money and they're like, oh, opportunity, opportunity, opportunity. But it's how well is that thesis defined? And is this truly a steal? And do you already have a fund with money that's already allocated where it makes sense to even bring this up, or just leave it alone entirely?
Totally, because portfolio theory and portfolio construction is usually a function of diversification. So
Yes.
It's like we want a little bit of stocks, we want a little bit of bonds, we want a little bit of alternatives, and within alternatives fits all this stuff. So It's an allocator's job to get all of their marbles in the right bowls, and then they're like, cool, we think this is going to generate an optimal return. whether it's based on up cycles, down cycles, et cetera. So opportunity funds are meant to exist to kind of coexist with, the more status quo on how allocators allocate their money. All right. Holy smokes. We charged right through that.
We did.
So just to recap, an investment thesis is something you need to define at a macro level, especially when you're fundraising. And in micro SaaS, it's most likely that you have a sector specific view or something that you're going after. You've conducted kind of a bottom up analysis of the firm with a ton of information because the seller has intent. Maybe there's a roll up component to it. This is going to be more around like the value creation aspect and how you take an asset and make it more useful. And we're almost always opportunistic. Sometimes we're turning it around. It's less common. Sorry, I'm bouncing all over the place. It's less common that you're just going hard at whole categories and it's informed via top-down thematic investment. With that, you see a lot of traditional private equity where they're hitting up private companies that aren't for sale. They have a point of view, et cetera. In micro SaaS, you kind of do the best you can with the surface area that's available to you, which is a function of sellers with intent. And then you get comfortable with the category, and then you make sure that the fundamentals of that individual business are compelling, and then you execute an acquisition, and then perhaps the value creation is going to involve a turnaround, and perhaps the acquisition is going to involve some roll-ups, some M&A. Boom.
Go to game.
That's it. All right, man. I get to call you birthday boy one last time. So birthday boy, always a pleasure, my friend. And we will run it back next week. We're going to be diving into, there's a little TBD, but we're going to be diving into a UGC tactical experiment. So we've done webinars and we're categorizing that as user-generated content, kind of drawing from the hearts and minds of your users to bring forth, the most interesting substance that you can, probably much more novel than the stuff going on for you as the software provider. We want to test a new tactic against that and then double down on that which provides the best results. So we'll be diving into kind of the blocking and tackling, how you get that experiment sorted, how you execute it, and then on the campaign side, how you compare results. That'll be a good one.
That's going to be a great one.
All right, Kalu, for the love of the game, my G, you have an outstanding rest of the week. Happy Thanksgiving. Love to the crew.
Happy Thanksgiving to you. Happy Thanksgiving to everyone listening. Take care.
No doubt. Cheers. Peace.
Peace.